us today. Just a reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee.
Sometimes coordinating multiple loads, clients, emails, and accounts becomes confusing and tedious. Introducing TIE TMS, the first all-in-one tool that helps you optimize your freight broker processes. You can send and receive quotes, review the shipment status, and keep control of your invoices all from one single screen. It's easy to manage and utilizes the best integrations. Don't take our word for it, our customers are raving about TIE. With TIE, you can improve your productivity by 75%. Go to tiesoftware.com and get a free demo now.
Good, Erin. Good. Okay, try it again. Good morning, everyone. Thank you so much for being here today. We have over 370 people registered to attend, so I really appreciate you guys supporting the podcast, showing up, being an audience. A reminder again, we love questions on this show. I actually do this show in a live format so that we can take live questions from the audience. Otherwise, we could just pre-record everything and release it. But I really want to give anyone who's listening today the opportunity to ask a question and get an answer before the end of this show. So please comment your questions in the show comments, and we're constantly moderating those. Aaron's behind the scenes. He's putting those up so we can see them to make sure that we can answer questions today. My announcement list is short, which is nice. So Manifest, which you see that logo on the screen because Manifest is coming up. We are almost exactly 1 month out from Manifest. And so that will be February 10th to the 12th in Las Vegas. If you need an excuse to watch the Super Bowl in Las Vegas, I just gave you one because the Super Bowl is on the 9th. So you guys can go in a little bit early. I will be getting there on the 9th as well. Watch the Super Bowl and then get ready for one of the best conferences that our industry puts on each year. So without further ado, I have a large panel of guests today. I'm going to go ahead and bring them all on so that we can do introductions and get acquainted with everyone who is on this show. Good morning, gentlemen.
Morning.
Morning.
Good morning.
I'm going to have us start as I see you on my screen. So we're going to kick things off with Ken, and I'll just have all of you guys go one at a time and introduce yourself. Tell us a little bit more about who you are, what you do, and who you represent.
Good morning, everyone. I'm Ken Adamo. I'm Chief of Analytics at DAT. I've been at DAT a little over 5 years now. Most recently taken over Corp Dev and partnerships in addition to my analytics musings, if you will. But in addition to DAT, I've got over a decade in the industry, pricing, data science, all of that fun stuff.
Awesome. Paul?
So my background is in data as well and machine learning, mostly in the field of quantitative investment and finance, basically trading. In short, basically my expertise is using big data to build predictive analytics to support strategy, decision-making, optimizing basically returns per unit of risk. At Transfix, I've been with them for about 3 years. I did a number of things, starting with pricing and portfolio management, running the data team, the data and strategy team. And now as a chief economist, I basically spearhead their data research and kind of help them build the tech and data solutions. One big disclaimer, the term economist is misleading there. I do not deal as much with big aggregates like inflation, unemployment, and so on, and more with granular data trends that we pick up in the market. So it's more of a data function than truly economic function.
Awesome. Thank you. Jason?
Hi, everybody. Jason Miller, the Eli Broad Professor of Supply Chain Management at Michigan State. And kind of my title not fitting a lot of what I do. I actually am anymore primarily an economist, do a lot of industry commentary as well, and then do my academic research and a lot of executive education.
Thank you. And Chris?
Yeah. Hey, Chris Pickett, Chief Commercial Officer at Flock Freight. Been with Flock for about 3.5 years, but Flock's been at work since 2015, scaling, we would argue, the first of its kind scaled shared truckload networks. What the heck is shared truckload? It's basically a way for shippers to buy access to truckload service. That means one truck, one driver, no terminal consolidation, only pay for the space you need. So effectively, truckload service don't pay to ship air. And as I think we'll get into in this podcast, we would argue that the cost of air is going up. In addition to that, I'm also the lead analyst at Pickett Research. So Pickett Research hung out a shingle in late 2020. Really divide kind of monthly ongoing commentary and forecast around what moves U.S. truckload, spot, and contract rates. And much of what I'll talk about, I think, in this session will stem from the stuff we do at Pickett Research.
Yeah. For anyone listening, if you guys hear something that is interesting to you or you want to know a little bit more about what any of these gentlemen do, I think all of them have been on my show just one-on-one at some point. So we had at least 30 minutes of conversation with each of these individuals on the Meet Me for Coffee podcast channel. You can go back and look at those episodes. And then in regards to today's show, talking about a 2025 freight market outlook, we actually had Jason, Ken, and Chris on in January of 2024, and we went over a market outlook. And then Paul joined my podcast not long ago in the summer, I think, and he shared his thoughts and outlook on the economy and the freight markets. So I'm intentionally bringing these guys back on to circle back and see in what ways did 2024 kind of live up to the expectations that we set for it last January? Were there any surprises? And we're just going to start there to frame up our conversation. That's going to be more forward-looking for the rest of the show as we are moving into 2025 and trying to prepare ourselves for what changes might be coming our way in economics and freight markets throughout the course of 2025. So I'll go ahead and I'm just going to start right back where I was last time. Ken, you joined us last January on the show. Can you kind of kick us off and let us know what did you see happen in 2024 that was exactly as you expected, maybe different, and just give us a quick recap of how things went.
Yeah, it's probably one of the most boring years in my 10 plus years covering freight. And probably on par with 2019, maybe a little bit of 2015 sprinkled in there. I think it went as we expected in the sense that it lingered about a bit. I think what we didn't expect was, or at least I didn't expect, I thought we'd see a little bit more strength in the second half of the year. We certainly saw some, but I think it seemed to peter out a little bit at 3 to 5% year over year positive gains when I was probably expecting more, 4 to 6 or maybe even 5 to 7 if I was feeling a little bit optimistic. So I think lapping really poor comps in 2023. 2024 was probably a bit of a disappointment for most folks, except shippers. Shippers, I have to imagine if I had one metric that I'd love to track, it would be the cumulative net golf handicap of all shippers in the market, and I have to imagine that went down in 2024. That's my kind of rearward-looking bold prediction if I could measure it.
I do remember. I remember specifically at the end of our show last year, we did talk about talking through those relationships and preparing for some type of shift in the market throughout 2024, even if it was on the back half. And we haven't, I don't think we really saw that, to at least to that extent that we were talking about. But yeah, I think there was a lot of conversations, a lot of golf played, a lot of meals had this year, and we're still kind of maybe waiting a little bit for something to change more than they expected.
I think that's right.
Paul?
So I actually share Ken's overall sentiment. We discussed predictions 6 months ago. We discussed our previous predictions, and we made some predictions 6 months ago. And, I get some bragging rights. Our MPE, so we forecast every lane on a DAT zip to zip, which is about 18,000 plus lanes. So our MPE, our error, it's under 0.5% for the last 6 months. Obviously, we're talking about the aggregate. There are differences between from lane to lane, but even taking into account, regional dynamics, the MPE, the error stays within 1 or 2%. So our predictions were relatively accurate. I say relatively because there are some differences. There are some predictions that were less accurate than what the average suggests. Anything surprised us? Yes. So even though we focus primarily on the data, and when we call these predictions, they aren't predictions as such. They are more extrapolations. We are looking at granular level, how trends in the freight market build up. So even though the predictions were fairly accurate on average, one thing that surprised us was the dynamic of capacity. So we noticed that mid-2023, the market started losing capacity. And by the end of 2023, that movement accelerated. So we expected 2024 to see an increase of that trend, which wasn't quite the case. And as such, the market remained oversupplied by and large dynamically, and prevented the pickup in rates that we predicted. If you remember our conversation for October, that bump in rates stayed minor and lacked momentum precisely because of the overcapacity that still defines our industry even now at the beginning of 2025. So that we got a
Awesome. Thank you. Yeah, I remember that conversation. So I also, if anybody didn't hear that episode with Paul, I really enjoyed that. He did talk quite a bit about economics, and he had a pretty interesting stance on that too. So I would encourage people to go back and listen to that one if you missed it. Jason, your thoughts?
Yeah, so I think I can remember when we had that. I was one of the biggest pessimists on where I thought 2024 would be, and I think in general the pessimistic outlook is what played out more so than anything. We had entered the year, manufacturing was looking really weak. The Fed still had interest rates high, where I was mixed on where I remember I wasn't willing to make a prediction on the second half of 2024. I was only focusing on the first half because we didn't know what the Fed was going to do with interest rates. I was figuring at the start of 2024, probably 150 basis points of cuts. That ended up not coming to fruition. We did get 100 basis points, but it all got stacked at the very end of the year. Inflation right now is persistently higher, so that's going to make 2025 harder to, I figure. But I know I'm looking for this next year to be a better year, certainly than 2024. The question is really how much better, and that's where there's so much economic uncertainty at the moment.
Yeah. And if Jason was our pessimist, Chris, if I remember correctly, I think you are our optimist. So
I was the optimistic counterpoint to Jason's sober, well-informed kind of perspective on what drives these markets. And I think, a year ago, I think I came into this discussion and I think I was predicting we could see an inflationary line haul index as early as Q1, basically that same Q1, and then go on to, I think I probably said a maximum of plus 40% year over year by the end of the year. And that was informed by effectively a cycle-based kind of perspective of what drives freight rates. So the idea that there's a cycle is not a controversial statement. But I would argue that, based on historical patterns, that cycle tends to be a little bit more, I think, consistent and therefore arguably predictable, maybe not, depending on how you look at it, than what most folks realize. So I think coming into the end of 24 or the end of 23, we were kind of bouncing through what looked like kind of the last legs of the deflationary leg of cycle 5. And I think my index was probably showing something like, minus 1% from equilibrium, driven by a pretty big surge in December and then even early January. We had this wild run on line haul rates, which kind of happens to some degree every kind of December and January, and projecting, okay, if that stays course, then hey, we're back into inflation land in Q1. And if that's the case, it's based on past patterns. You can kind of retrace from equilibrium to peak. That would put us at a plus 40% by the end of the year. End of January, beginning of February, rates fell off a cliff. Kind of characterized as the great kind of St. Valentine's Day freight massacre, where capacity came back to the market as it often does. Market was softer than what it had looked, early January, and basically that inflationary breach ended up moving from Q1 to Q3. So we did get it. It was just 2 quarters later. And so I think what somewhat surprised me is just that additional 2 quarters. And so again, based on the last 5 or 6 cycles, which arguably is a small data set, typically see kind of a 6-quarter up in terms of year-over-year increases in line haul rates, followed by a 7-quarter down. This time around, we got a 7-quarter up, followed by a 9-quarter down. And so certainly different, but I would argue hardly, generational or, completely kind of unexpected. So what drove that? I think, 2 things. I'm sure there are a lot of things that drove it, but I think fundamentally, how weak diesel got and stayed. So I think, diesel's down like 20+%, this year, kind of year to date. And I think the failure of industrial activity to respond, and a lot of what Jason's commentary was on, just the risk around the likelihood of manufacturing seeing any material bump in activity. So historically, I would observe that industrial production tends to track consumption pretty well. So the economy held up. I mean, consumption was strong at plus 2.5 to 3% year over year, but we never got the pickup in industrial production. You never saw any material change in inventory to sales ratios. So it was pretty darn stagnant, kind of in line with Ken's kind of commentary around almost the year that never was, from an industrial activity standpoint. And so I think the question for me going forward is, now that we've kind of breached inflationary, Q4 closed, at least based on kind of my version of the blended DAT index, plus 6%. So we're technically on the inflationary side of the ledger. Now, again, the big question to Jason's point is, to what extent do we see any material improvement versus, the year that never was of 2024?
Yeah. I'm just, as you guys talk, I'm remembering more and more about our conversation last January. I think Ozempic was in that conversation. It was a good one. Okay, so that brings me to this side of things. When I created this podcast originally, it was to discuss macroeconomics and freight markets, and specifically the connection between the two. So I want to keep consistent with that theme. And I want to ask you, gentlemen, because all of you do in some capacity, while a lot of you are more data-driven and freight markets and analytical, we are still looking at economic indicators on a regular basis. And so I want to visit now the topic of macroeconomics and what's going on. What do we think will be happening in 2025? What's already happening here at the beginning of 2025? And I mean, just a couple call outs to kick us off. I think we all expected slightly different outcome when it comes to interest rates at this point. Maybe a different outcome on where we stood from an inflationary standpoint at this point. So I think what I really want to learn, because I'm always trying to learn on these things selfishly and then let the audiences learn along with me, is what keeps 2025, or at least the first half of 2025, from being any different than what ended up happening in 2024. Because I feel like we've just kind of been a little bit stuck with this whole battle against inflation, interest rates not exactly living up to expectations when it comes to those cuts. So I'd love to hear all of your gentlemen's thoughts on that. I'm going to change the order up a little bit. Let's start with Jason, and I'd love to hear what you got to say about that.
Yeah, so I mean, right now, some of the indicators we've got from December data. So ISM's the PMI sub-index for new orders. That's really the only thing I look at as a leading indicator. That has been showing a little bit of positiveness over the last couple months, but it's still not to the type of readings I would like to see that we saw in, let's say, 2017, when that really kicked the market off, when we were in the high 50s, low 60s. We were like 52.5 for December. We have seen motor vehicle sales, especially light trucks and SUVs. The last 2 months have been phenomenal. The data that just was released yesterday for December put December's seasonally adjusted light truck and SUV sales as the third highest ever. The only explanation I have for that is the presidential election outcome, because the last 2 months there's been a huge surge, and I can't think of anything else that's taken place. So we've got some good signs on that front. On the housing front, mortgages being at 6.9% is not what we need, though, as an industry, because that will keep some buyers from, moving in on the housing space. The 30-year mortgage tracks the 10-year treasury yield. It's not necessarily tied that much to interest rates in a mechanical sense like bank prime is for capital investment. And so right now, the question I think that the market's looking for is what policies will the incoming Trump administration put in that may or may not be inflationary. If you would see a pared down tariff, mass deportations really not being actually mass deportations, that would probably cause 10-year yields to drop. If we get universal tariffs and real mass deportations, you're going to see those 10-year yields are going to stay high because everybody assumes they're inflationary. So the housing side, we've got to really watch closely, because the one part of the post-COVID boom that doesn't get talked about was how existing single-family housing sales jumped from like 5.4 million units a year to 6 million units a year in just a matter of a couple months. And that brings with it a lot of freight. Existing single-family home sales are still really weak right now. They're around, I think, 4 million units a year. So they're down 15, 20% from the pre-COVID baseline. So be watching that closely, watching where commodity prices are at, because that determines investment in ag equipment, that determines oil drilling. The one thing I'd caution folks is there's no reason to think 2025 is going to see a big increase in fracking. That was something that did occur in 2017 and drove a lot of freight demand. But with oil at 70 to 75 a barrel and U.S. already at record production, there's no reason to drill more at the moment. So those are kind of the big ones that I'm, looking at. We've got some positive signs, but right now there's just so much economic policy uncertainty regarding tariffs.
Okay, Chris?
Yes, I'd probably stay maybe a level higher, right, than that, but it's a function of kind of supply and demand, and it's what is overall consumption doing. And again, right now it's been remarkably flat to slightly kind of up into the right, and that's driven by a lot of the factors that Jason mentioned. So I think as long as that stays the course, I think there's reason to be optimistic on some uptick in industrial production at some point. But yeah, the idea of that suddenly going to tip to 45-degree angle up on the right is probably not realistic either. So it's kind of this waiting game around how long can industrial production and consumption stay so far apart. We historically really haven't seen this level of divergence unless you've been in the midst of a materially painful recession. And so we've been going on 6 quarters of flat to slightly up consumption, yet industrial production has been hovering down at 0 to -1% for the last 6 quarters on pretty tepid inventory activity. The question is, how long can that occur? The volume indicators we tend to look at, cash shipments, the ATA volume index, those bottomed off of their own kind of year-over-year deflationary inflection points about 3 quarters ago. And so going into kind of Q1, all 3 of those industrial production and both volume indicators have kind of settled right at equilibrium. Industrial production's flat, volume is pointing up. So I think just based on those patterns, I think some optimism, we'll see some uptick in overall freight demand. But unless we get material break on the constructive side, either in housing or some of these other factors, then again, they're going to be a slow melt up. But certainly a positive up into the right, unless again something catastrophic happens with tariffs that puts a massive dent in overall consumption and sends us back over the falls. I think those are the big ones. It's consumption, it's industrial production, and then relative inventory levels.
Yeah, and just correct me if I'm wrong, but we had a good year for consumption, correct?
It was great.
We really weren't. It's not that we had like a weak market necessarily. It was just kind of stagnant compared to the last. So.
It was a slow ride. I think it was like plus 2.3% ish on a year-over-year in Q1. We closed Q3 at plus 3%. So it's slow and kind of steady, which is exactly what you want to see. What didn't happen, which was the surprise, is you never saw that pull up in terms of the level of industrial activity rising to meet that consumption.
Yeah.
So clearly something else is happening. Either it's different levels of consumption, or we haven't drained excess inventory just quite yet.
I knew you'd have the numbers for me, Chris. I always have the ideas floating out there, but never the exact numbers there. So, moving on, Paul, what are your thoughts on the economy for 2025?
So I will think 2025 will look nothing like 2024. And if I'm going to take a different perspective on it. Last time we spoke about the Fed's fight against inflation, if you remember, and I expressed my doubts on whether this announced victory was real or not. So as a matter of fact, inflation remains sticky. The economy will get tested by some very big experiments, including tariffs. Yes, consumption has been strong in 2024, but I would push back by also stating that in the first 9 months of 2024, if I remember well, this is a ballpark number, credit card defaults jumped by about 50%. In fact, delinquent credit card, I think, doubled over 2024. And basically, the saving rate for the bottom third, which is the most prone part of the population for consumption, is now officially 0%, meaning that there is no more significant ammunition. There is no momentum that we built post-COVID, with excess liquidities and so on and so forth. So whatever happens in 2025 has to be created. We have to create an economic momentum that benefits everybody. So I have no prediction on how things will go. I'm not much of an economist in the same way Jason is, but I would say that there will be a lot of volatility, and for the economy at large, and also for the trucking market in particular. I do not expect. I expect some strength, so I share probably the same opinion as most people on this panel that 2025, there are some good dynamics at work in the trucking market, but we are always depending on the economy at large, and there are major uncertainties that can generally derail us from the normal recovery that the trucking is already feeling.
Yeah, I think there was a lot of noise a little too early, in my opinion, around like credit card delinquencies and the personal savings rate. I covered that in one of my newsletters. A couple of them ended up being some adjustments made to the personal savings rate. They're like, oh, we were actually wrong. Like, it's not as bad as we thought it was 6 months ago. But I think that people kind of caught on to those trends when they had just started, and we were coming up from historically low lows. And so they were dismissed as well, no, look where we're at. And then I haven't seen a lot of revisitation of that subject in the last year. So
if I can add something very quickly, this is actually a dynamic equation. How the consumers were reacting is very much rate dependent. The same for mortgages. Property prices are the most unaffordable on record, right? And the problem that we have is we're not going to get into the debate about tariffs. I think Jason might say a few words about it. But by and large, if we get tariffs, if we get inflationary pressures, at the point in time when the interest expense is about $1.1 trillion per year, and it's on par to actually matching Social Security, which is about 1.45 per year, then interest rates will have to stay higher for longer. So I cannot imagine how the consumers will help us again in 2025, knowing that even if, let's say, the saving rate is marginally better than zero, but it will still have to support the interest of the debt at very, very high levels. So this is something that hasn't been answered, and one way or the other could determine what 2025 will look like.
Thank you. Ken, anything to add?
It's hard to add something after that crew. I think the only thing I would add that hasn't already been said is there's strong evidence that we're pretty much at equilibrium now. And the reason I say that is if you don't need a degree in economics, what you need to look at is when you look at things like road check or peak, what happens is the predictable effect of those things happen. So trucks go out of service during road check week, rates go up, and then they go right back down. So they're not serving as like this catalyst to launch markets into a long-term up or down, like Ukraine and the fuel spike brought things into, like, they catalyzed the collapse of the market. Harvey and Irma, hurricanes aren't inherently inflationary. It just happened at a time where it kind of catalyzed the next cycle that was largely going to happen anyway. But when you're at equilibrium, what you see is these things happen and they go back to normal. So I think this burst of cold weather, logistics, just to take a little bit of a step back, logistics is like very calendar related. If you look at why we had a pretty good peak this year, it's the latest you can possibly have Thanksgiving. Like, I think every 100 years when like leap year coincides with like, I don't know, some pagan holiday that I'm unaware of, like the things come together where you could technically have Thanksgiving on the 29th, but that happens like once every century. So the 28th is the latest you can have Thanksgiving. It collapses the number of shopping days, and freight tends to be spikier, and that's what happened. This winter weather will probably prolong return influx that we typically see. So if you're in logistics and you're looking at the calendar, the longer things stay busy into January, the better. Because we're trying to narrow the gap between the retail peak and the spring shipping influx. And the more we can shorten that, I think the better the hopes are for a really strong end of the quarter, but a stronger Q2.
Yeah.
That's the more simpleton-minded view of it, in my opinion.
I didn't know this was a leap year until like a month ago.
Last year was, right?
Oh.
Every election year. I think we're on a cadence where every election year is a leap year.
Yeah. Okay, well, that was good. That was actually a great transition too into my next question, which is more thoughts specifically on the freight market outlook for 2025. So we just covered macroeconomics and kind of thoughts on that, and then you just kind of bridged into what we can kind of be thinking about for freight markets. So as we are moving into 2025, as we're going through, I guess what's to your point, kind of still an extension of peak because we have had some winter weather and some other things. What are we looking at? What are we expecting to see for the freight markets, predominantly discussing domestic transportation in the next 12 months? And
I guess I would jump in. It's almost to build on Ken's point around, when you're in this kind of stasis of equilibrium, just the vulnerability to these known events just gets that much higher. Yeah. So DOT checks happen, you always have produce seasons, et cetera, et cetera, et cetera. But the impact on the freight market will be exaggerated, arguably, if you're in a net kind of scarce capacity position, versus the last 2 years we've been down to the trough. And so I think it's important as we go into 2025, if arguably we're in some version of equilibrium, you can kind of argue, is it +5, is it flat, is it at -1? But at equilibrium, the market's going to be much more susceptible to these events that can catalyze much more of a move, whether that's a port strike, whether that's another black swan that are becoming more and more commonplace, weather event, right, that could come into place, whether it's a produce season that goes sideways. And so it's these seasonal or could even unexpected catalysts, again, tend to have much more of an impact during either a equilibrium or a kind of inflationary state of the market. And I think I would kind of build that into kind of, it's going to go into my responses to kind of where we believe kind of things are headed. I can almost roll back, right, the prediction I made a year ago, where it's okay. I think, it's not we're about to breach. It's we've already broken into inflation land based on at least one measure, in Q3. I think a big indicator would be what happens in the next 3 weeks. And to Ken's point, it's you typically see this kind of run up in rates, your capacity exits for the holidays or for cold weather, and then eventually kind of comes back in. So you always see this almost 10 to 15 cent, reversion, in terms of line haul rates from November in terms of where you end up in February. And so we're kind of on the upper end of that kind of right now, where rates are building higher. If we see a material drawdown in terms of that normal seasonal cap comes back in and we get the same 10 to 15 cent, maybe 20 cent kind of pullback, then I think it is a kind of a lower, right, for longer drive where, I would expect maybe that to drive a 20% plus year-over-year peak. Even then, I still think rates, spot line haul rates are up 20% year-over-year by the end of the year, which is probably a 15% move from this point. If that doesn't happen, if we see the cold weather prolong, if we get some version of a port strike that throws another kind of monkey wrench into freight flows, and you don't see that pullback, then I think even without a black swan event, we could easily see rates 30 to 35% higher on a year-over-year basis by the end of Q4. And that's spot. And I think contract rates tend to follow spot by a quarter or two. So I think our contract forecast, which is basically just the CAS, line haul index, shows, CAS rates, closing higher year over year as early as kind of next quarter, and then maxing out somewhere around 8 to 10% on a year over year basis by the end of the year. So basically, I think when you think rates are going up, the extent is how fast and to what degree is the unknown.
Yeah, I just maybe the thing, because I have very similar thinking to Chris here. Jason and I were talking about this on another podcast right before the holidays. I think there's a scenario you have to do in your mind on what happens if this year doesn't manifest. Great pun with what I'm looking at on the screen. Doesn't manifest the way Chris talked about. I don't think it needs to be 30 to 35%, but if we're not rolling out of next year, or I guess now this year at plus 10 to 15%, maybe a little bit better year over year, there's going to be some pretty dramatic reshuffling of truckload capacity and probably even that longer tail of brokerages that just aren't able to swing it anymore. I don't know anyone of any credibility that would argue that this industry can survive another year like 23 and 24. It's just, it's infeasible. So I think understanding that fundamental cost pressure does come into the equation at that point, I would think we don't need the 30 to 35, although I think it's totally possible. I think 10 to 15% by the end of the year would give you a year on year of like 20%. And you split the difference and say the market's grown at 10% CAGR over those 2 years. So I think that's probably generally what we would need. But absent that, I might start to say bloodbath at that point. If we're having this conversation in 2026 and we only exited the year at like plus 2 or 3%. We're probably in a macroeconomic recession too at that point. I'm not an economist, but I would have to imagine that the correlation there would have to put us in some sort of like macroeconomic calamity.
I would say like it's part of that slow motion bloodbath. It's probably happening now. I mean, a lot of I think was what has driven the last 6 months is not like industrial production's off the charts, because it certainly is not. It's some version of that slow bleed, either from brokered capacity or asset-based capacity, gradually leaving either temporarily or permanently. So I think that's kind of an ongoing force where, again, I don't think we get to plus 30% unless we get IP production back up to probably plus 2 or 3%. Absent of that, just based on the dynamic of that slow motion bloodbath and those cost pressures piling up, even with a pretty forgiving diesel environment, then those forces by itself increase that capacity exit that can drive the increase in spot rates.
Yeah, I can provide a little color. I should have. This will probably post on LinkedIn next week, but the quarterly census of employment and wages, which is the actual payroll administrative records data for the long haul truckload sector, kind of to add some color. We had a huge drop between Q4 23 and Q1 of this year. Q2 showed further downward decrease. You have to assume we're going to have another, there's a big seasonal pattern where we do see folks hop out. If a lot of people leave, they decide, okay, I've had it, I'm done at the end of the year type of thing. Right now, capacity is right where it was in 2019, which means freight volumes are basically back to where they were in 2019. So I've went on record. I could see spot rates. I think for me, the higher end is 15 to 20% year over year increase by the end of this year. That's what I wrote about in Supply Chain Management Review and what I put out on LinkedIn. Contract wise, if we use BLS PPI, high end for year over year would be probably 10% year over year. That's what we saw in 2018. That's assuming nothing wacky happens with fuel. Which would imply a much greater connection between contract and spot rates than existed 10 years ago, but I think that's a reasonable assumption. I don't see a breakout like we had in 17 and 18, because that was just a unique convergence of very strong growth in industrial production and manufacturing. Two absolutely horrible hurricanes, and especially Harvey, did meaningfully increase freight demand for a small period. And you had the ELD mandate taking effect. That was a major shock. And not to mention, you had one of the worst polar vortices that hit in January of 2018. So you had all these things coming together. You're unlikely to have that combination in the back half of 25 into 26. That production growth, yes, it is likely to happen this year. But, ton mile index that I co-author, in 17, 18, that was growing by 3.5 to 4% year over year. You have to kind of go back to exiting the global financial crisis or the housing boom in 04, 05 to get numbers like that. This year, I think we're at 2%. Capacity still may exit a little bit. So that sets the stage, if nothing wacky happens, for strengthening. Everybody has to remember, though, 2017 wasn't affected by tariffs. Those didn't start kicking in until 18. And really the back half of 18, especially October, was kind of the big second tranche. We're potentially looking at tariffs taking place a lot sooner, which throws things off a little bit for making, bold predictions on the second half of the year, which is why the article I just wrote for SCMR, I'm like, I'm not touching the second half of the year. I'll make a prediction through June, but I'm not touching H2 of 2025 yet.
So I can jump in that space left by Jason. So I'm going to do what we've done before. We publish monthly predictions for the next 12 months. And I know this is a crazy exercise, but we still stick to it. So we see rates go up between 14 and 15%, but we have a huge disparity from region to region. And actually, as we zoom in almost to lane level, even bigger disparity, dispersion, and volatility. So, Northeast probably around 20%, whereas the West we see closer to 10%. But overall, I think we all agree around this number of about 14, 15%. That being said, I want to share something with you, some food for thought. The way we predict rates, as I mentioned, it's a bit of an extrapolation. So we do two things. We use something that's called Gaussian processes to model two different things, seasonality and the market element. And seasonality is extremely important to Ken's point, because this is what makes the structure of every single lane. Is determined by weather, is determined by product. You're delivering water in July or August. And this seasonality, this pattern repeats itself every year with some variation. This variation is often driven by the market element that kind of pulls seasonality up when the capacity is tight, right? So the range is bigger, or flattens it when the capacity is loose, like today, by and large. The interesting thing that we are seeing now that we haven't seen before is that the core seasonal trends are still surprisingly weak, meaning that we do not see the signs of life at the core level, at the most granular lane level, that are good predictors for rates picking up imminently. Remember, by the nature of our exercise, by extrapolating, you're just looking at the small momentums building up. So the shorter the span you look at, the more accurate we are, because again, it's just like a big truck momentum. And we do not see much of a momentum right now, which adds a different issue to our prediction, which is the path dependency. If we still predict 14%, 15% rates by the end of the year, when is it going to happen, considering it's not happening to that extent today? So for us, we see a turn happening around May or June, where this is supposed to pick up some speed. But the interesting thing here is that we see something that we haven't seen before, weak granular markets, but the seasonality expanding, which could be an impact of what Jason is describing in terms of capacity. At some point, even on a weak market, the lack of capacity, especially in certain regions, means that whenever things are picking up due to the nature of the lane itself, that increases much more, right? You have less trucks when you need them. You still don't need them most of the time, but during DOT week, during the peak, a seasonal peak, you need them, and that seasonal spike is going to be much higher than usual. So a lot of dispersion, a lot of volatility ahead.
I have probably already seen multiple different publications or references to growth in 2025 being backloaded to the second half of the year. So if anyone has any final comments on that, I've seen that now mentioned several times, that it seems most people are saying probably steady as she goes, more or less, for the first 2 quarters, and then we'll see some momentum in Q2. But a lot of that movement, you guys are sounds like we all kind of fell somewhere between 10 and 14, 15% would be happening more so in Q3, Q4.
I suspect we'll see it earlier. I mean, it's always the easiest forecast. Things will stay just like they are, and then at some far out point in time, we'll see a big jump. But again, I don't think I don't disagree with any of the. I think the perspective of Paul, Ken, kind of Jason, they roll into this very similar ways. But it's that's the $1 trillion question: is when do you start to see this pick up? If not now, what is that catalyst or that combination of events where you start to see things?
I think it could start. I mean, if you look at the one ratio between DAT's contract and spot that I always look at, 10% has always been the rule of thumb for when it shifts. Right now, December was like 13.5. January, and granted, Jan's really preliminary. That's at 12-ish. We're getting close. So for me, it's been no sooner than March could it flip, March or April. The real question to me is going to be, how does the home building season kick out this year? And if you start seeing a robust home building market, then I think that will be key if you start seeing people more willing to move. But it's going to be watching a lot of the industrial production data to see, if we start to see things changing. I think per the comment, one of the big issues that we had in 24 was while consumer spending was good, that hard industrial part of the economy that doesn't show up in the GDP figures because it's somebody producing plywood that doesn't actually contribute directly to GDP. It only contributes when it's sold to final demand. That production wasn't good. And so a lot of these intermediate input sectors, another big one is paper manufacturing. That fell off a cliff and starting in Q2 of 2022, and it still really hasn't recovered. If those numbers are there, that's about 1 million truckloads a year lost from the market just with the decrease in paper production alone.
Okay. I think we're at 47 minutes, so I'm going to transition to kind of a final question. I would love to encourage anyone in the audience to put any questions that they might have in the comments. We'll try to get to them here on the show. If not, we can always revisit those. Even if you're listening back to this later, if you come back to the LinkedIn event and paste your questions in the comments, tag us. I'm sure we'd be happy to jump in and share some thoughts. My final question to everyone here today is, what is the advice that you would give? We typically see a beautiful blended audience of shippers, brokers, and carriers listening to this show. So we probably have a little bit of everyone listening and wondering what all these predictions we just made mean for their business for 2025. And so I would love to get some of your high-level thoughts on, if you were a shipper, broker, carrier, what would you be considering for the year ahead? And I will start with Paul.
So when I go back to Ken's point about the cycles of the trucking market, and those cycles, the seasonality at the lane level, and we make general predictions, and that these are supposed to give an intuition of how the overall market pattern will be for 2025. But ultimately, if you're operating, if you're a shipper, broker, carrier, you care about the right level of granularity where you can action those predictions. I mean, what does it mean that the market's going to go up 15% if you're operating somewhere in the coastal region or west, and so on and so forth? So, I wanted to do an exercise, and I'll post that at the end. Some of the predictions so we took, for instance, Elizabeth, New Jersey, and we provided 20 predictions for different parts of the country, and then for 12 months. And if your destination is Brooklyn, then rates are going to go up about 9%. That's our prediction. But if your destination is Lakeland or Miami, that is over 50%. So generally, you need that level of operational visibility and granularity to actually make something out of this prediction. What I would say in general is that the volatility is back, will be back in 2025, and you will have to manage. What does it mean? It would mean that you need to know your strengths and weaknesses. And by now, after 2.5 years of recession, most people who are still in the business kind of have a good idea of what these are. But the question will be, how do you leverage your strengths and weaknesses in a market where you'll have a lot of volatility, meaning potential for dropping margins on both sides of the spectrum? And obviously what I'm going to plead for, it's what we do. This is the marketing part. So here you go. The advertising is focus on data. And, even though that's what we do, and obviously this is what I'm going to say, I think that the tool that every shipper, carrier, and broker has to have, whether it's ours or another, will be a framework of analysis that is based on data. And this is everybody has an AI play right now. AI doesn't create, how could I say, magical formulas. It simply extends human insights and knowledge, but you need to do it at scale and in a very short period of time. So therefore you will need to have that kind of tool that would allow you to navigate the market that for sure will be full of surprises in 2025.
Thank you. Chris, I'll have you go next, and then we have several questions. So after we get through our final thoughts here, we'll jump into a few questions.
Yeah, I guess I would build on Paul's point, where it's just the visibility, understanding what's happening to you, good data, understanding how to compare yourself to the benchmark. Obviously, DAT is in this business and puts a lot of great data out there, and the right control system to be able to do something about it. I mean, we're at the leg of the cycle where spot rates are starting to accelerate faster than contract. We can kind of debate, see what happens around to what extent and how they go. By experience, when that happens, very quickly you see this great battle between spot and contract. Where everyone that's holding contract rates that become maybe less attractive if you're on the carrier broker side in an increasing spot market will look to say no to as many of those contract tenders as you can to have more access to spot. Everyone on the procurement side and the buy side will be working to ensure that their contract carriers are honoring their contract rates. Then you'll see this great campaign around everybody wanting to be shipper of choice again, certainly by kind of Q3 to keep more and more carriers on the reservation. So I think the shippers that leaned into innovation, that leaned into strategic carrier programs will be in a much better position. But whether you're on the sell side as an asset-based carrier and the buy side as a shipper, someone in procurement, or in the middle as a broker, regardless, I think it's all about understanding what's happening to you within your own network in terms of where do you have contract positions, how are they performing, where are they at risk, what's your exposure to the spot market, how do you feel about that as the market shifts, just understanding at the baseline where you're at, but then also having the tools, the tech, the TMS, whatever it is to be able to do something about it, what's happening to you, how well your contract carrier is performing, do you care, what should you do about it, but then also in a team that's empowered to be able to take action. And so it's all about nimbleness and velocity, moving quickly. One, you need to have data. Two, you need to have an opinion, right? So it's not just dialing into podcasts like this to get a bunch of opinions, which is fantastic, but it should go into some sense of your vision of where the market's headed, what that means for your business, and how you're going to react if any one of these scenarios comes to pass. So I think it's all about building nimbleness and velocity, on a bedrock of data and systems.
Can I add something? Because I couldn't agree more with every single word that you said. I would even push it a little bit further and say it's better to have a wrong framework than operate without a framework. We obviously, none of us know what the future will bring, but having a framework for considering it, for simulating it, for having scenarios will help you survive.
Yeah.
Chris, before I let you go, do you want to maybe touch on this? I felt considering Flock's position in the market, this might be something you could speak to. I'm curious if you've seen shipper innovation in the last 4 years have an impact on, a shipper's ability to look for increased efficiencies in their transportation.
1,000%. So I think as we move into this market again, you can see that arguably some version of the same thing on the supply side, but as you go into a shifting market, optionality is key. And so if you're a shipper, that means, where do you have access to different modes? And so maybe in one market, intermodal doesn't make sense. When spot rates, pop by 20%, hey, maybe it's different. But you've already done the homework, right? What lanes can shift to intermodal, for example. You've already got, vendor relationships in place. You've explored building access to things like shared truckload. You talk about the penalty cost of shipping air is just a proxy for spot rates. And so depending on, the characteristics of your freight, having access to have different ways of moving things like shared truckload, even though it might make economic sense in a down market, can make an awful lot of sense in an up market. So like the shippers that invested in that, drop trailer networks. I think I saw some of these notes come up. The shippers that didn't kind of squander the downturn, right? That didn't spend all year on the golf course, improving their handicap, that have kind of planned for this eventuality. I think will have put their organizations just in a much better position to outperform. It's all about not necessarily did you get it right, but it's did you adapt faster than the competition and maintain service levels and transit times even just a hair bit better than the folks that didn't.
Yeah. Jason, I'm going to come to you next on your kind of thoughts on advice to everyone. And then I'm going to, again, get two birds with one stone here because I feel like this is a good one for you to address on this question Tom asked. Isn't part of the inflation problem that the Fed slowed its QT quantitative tightening? So there's still too much liquidity in the system.
Yeah, that's one that's going to get even beyond what I just tend to really focus on. I mean, the real problem right now for inflation is simply the fact we have a lack of housing. And so it's the shelter component of CPI is really driving that piece. Challenges, as we mentioned, housing prices are at record levels, so it's very unaffordable for folks. And we have mortgage rates at over, nearly 7%, which makes it, very difficult. I think the big thing that I just caution folks is that I think people got trained with the mentality of, if you go back to 2020, the market literally flipped like a light switch between May, when truckers were protesting at the start of the month in DC, that brokers were keeping rates artificially low, to by the end of June, when rates were literally going pure vertical. That's not going to happen here in 2025. You're not, in the same way, you're also unlikely to have what happened in 2022, which after March, we just started to see spot rates head straight down, even when you included fuel. So neither one of those scenarios is likely. And so just be patient. This is going to be, in my mind, look a lot more like the 2013-14 market cycle, where it was a much sort of smoother, steadier build. It was still 20% up year over year by the time we got done with things in 14, but it's much more likely to look like that. And again, kind of going back to data, triangulate data sources. I mean, be looking at load to truck ratios, be looking at where spot rates are at. I love FreightWave's tender rejection index. See where things are moving on multiple of these different things. Be checking various parts of industrial production. And then also realize that, hey, 2025 may not be a great year for the industry. Let's say something weird happens, but you could still have a good year. So there's tremendous amount of variability spread around the average. There were some carriers that grew like weeds in 2023 and 2024 and had good years. That was unusual, but there were some. There were a ton of carriers, believe it or not, that somehow went out of business between March of 2021 and March of 2022. We know that from the government data. 30% of the firms that started up between March of 2020 and March of 2021 were done by March of 2022. So 30% of people couldn't cut it in that market. So just be cognizant that what you may have, because you've gotten lucky with a couple good shippers, that may insulate you from what the market does. Conversely, 25 could be a great year, but your wagon is hitched to a couple shippers that are really struggling, and you're not in for a good year.
Yeah. Ken, you want to put a bow on all this?
Yeah, I mean, it's going to be the toughest. First of all, I'll give a big IO out there to Matt and Cody.
I also thought maybe this
a horns down for our UT fans coming up this Friday as the Buckeyes travel to the Cotton Bowl. Yeah, it's the toughest time of the entire cycle to be pricing as broker. I mean, it's just, if you were employee of the century when you were pricing freight in the spring of 22, it's really, really, really difficult now because rates are going to go up. You don't know when, you don't know how much. So I think it's just, if you can shorten the contract length at all, if you can have really good, honest conversations with your shipper about like, this is the rate, I'm confident, but I have this uncertainty, and you should be thinking about that too across all of your modalities. I think those are good conversations to have as a broker. You're seeing a lot of brokers too really enhance their vetting and carrier management capabilities, whether it's through tech, through process, through governance right now, which is always good practice. If you're a shipper, I think it's just understanding that the good times, to quote Merle Haggard, the good times are probably really over for good for the next probably 4-year cycle that we're going through. Things will go up, things will tighten. We're already seeing a lot of that. Yeah. We had our big shipper event this fall, and they're already starting to see maybe not so much of a compromise on service, but certainly some rate pressure, and the bidding isn't as easy as it was. If you're a carrier that's made it this far, and again, just to remind folks, there's as of this morning, I think 305,000 for-hire interstate motor carriers out there. It's not like this is Mad Max where like there's 10 carriers left and everyone's vying for them over the holidays. There's a lot of carriers still out there. I'd say like at most maybe 10% of the total eligible carrier pool went out. That's probably an overstatement. During all of this, Jason might have better numbers on that. But if you're a carrier, again, rolling into a new year, being mindful of, it's always a good time to look at your insurance. You're going to get your taxes done, all of these things that you have to go through. But if you've made it this far, I think investing into next year is always prudent advice.
Do you think that there is a chance on the brokerage side of things that when we talk about spot rates going up, like that's, a good thing. But what we have seen, and Ken, I know you've put some data out on this before, is that there's contract rates lag spot. A lot of brokers cover contract in spot. We still have quite a bit of brokers with contract rates that they own right now. Do you think that there is actually like a potential to see an increased number of exits again in the brokerage front when we start to see this shift in the spot market, if that happens? I'm just trying to wonder, we've 2 years of a very not great freight market for these guys, and then the spot rates start to take off sooner than their contract rates end. Do these brokers have that type of runway, or do you think that that's going to be kind of part of these negotiations that are happening this month and next, is that they understand they don't have that type of runway if that situation happens, and so we start seeing some tougher negotiation tactics happening in the next couple of months? Just thinking out loud.
I mean, we saw over 5,000 brokerages go out of business from the peak. So I think it's like this lesser reported metric, right? I mean, again, if you ask FreightX, every broker is a millionaire. They're all driving G-Wagons, right? They all live in $1 million condos in Laguna Beach. Like that's actually not what happens. I think if you're a broker, so let's just kind of to ground ourselves on what a broker worries about really quick. A trucker needs to worry about like their operating costs and being safe and maximizing revenue. So if you're a carrier, I'm minimizing my operating costs and I'm maximizing my revenue. If I'm a shipper, all I'm trying to really do is maximize service and minimize costs. So it's like a 2-point optimization. The brokers add a third leg of the stool in that they need rates, margin, and volume to all kind of work in harmony. And at each point in the freight cycle, there's actually different levers pulling on rates, volume, and margin. So, right now, margins from probably a dollar and a percentage perspective are compressed, but volumes came in pretty strong through peak, and rates maybe come up a little bit. So what I think we'll see is as rates get rebid, you'll start to see a little bit of added pressure come off in margins, but you're really like the front end of the cycle for a broker is always about rates and volumes, not so much about margins. Some of the worst percentage margins for a brokerage occur when rates are like climbing really, really steeply, but they don't care as much because the dollar per load margin goes up, even though the percentage margin goes down. So it's this delicate interplay. I think most brokers are probably through the worst of it. What you're seeing now that you didn't see last cycle is working capital is much more expensive, unfortunately, for brokers. So you're seeing broker participation in factoring go through in a level I've never seen it before. So brokers factoring their shipper receivables, and that's just because working capital is a premium. There's a lot of things that put Convoy in the ground 6 feet under, but really what put the acute thing that finally took them down was they couldn't pay for their trailer leases. So it was a working capital problem. And I think you're starting to see some of that in the industry right now, where if you have drop trailers, if you have any kind of working capital constraints, you're probably facing a pretty precarious position at the moment. But
just to your point, Ken, what I would also add is that the job for a broker is going to be that much more difficult in 2025, because when you rely on the market component, whether rates are going higher or lower, you have some sort of visibility and some sort of framework that the market gives you. You either have a lot of capacity or you have rates. Even if your relative value diminishes, rates are going higher. Now we are going to go back to a more normalized market, meaning with huge regional dispersion, with a lot of volatility across the board, where the path dependency matters. To your point, Samantha, if you are covering a contract transactionally, when rates go up or down, matters tremendously, because you might not be able to support that contract at some point in time, right? If rates go up one month 10% and you are relying on spot transactional to cover it, and you might lose your customer, right? despite overall the market becoming more bullish and longer term more promising. So the detail is what might kill bad organization in brokerage right now. And again, this is why you always have to go back to a framework of reference based on data to have the visibility at the right granular level where you can operate, where you can make changes, where you can manage an award, where you can optimize margin. So you need to sharpen your operations for 2025 in almost any scenario.
Yeah. I mean, the one thing that I think, just maybe to wrap all of this up, is I think it dovetails with most of our mission really well, is most brokers, like on the average, are really bad at pricing. Like, when you understand that, like, their life and death of a broker is largely fought in the battlefields of pricing, most of them are really bad at it, right? Like, we all tend to think of like the large, footprints in downtown Chicago and those logos on those buildings. Like, they're really good at pricing, and even that, they would tell you that they're not as good as they want to be at pricing. But like, your average of the 20,000 brokers, probably 24,900 of them are really bad at pricing. And this is the time when that can really bite you. And it's tough. It's tough to make a living, right? I used to walk around a brokerage floor with pieces of paper and ask 5 of our most experienced reps to quote a very, what I would think, pretty common lane, and the dispersion would be wild. And so if you're relying on that as your pricing strategy, you're going to be in for a really rough you've been in for a rough year and probably another rough couple of quarters. Anyone can price freight when the market's on fire, right? When you have the leverage, it's easy to price. When you don't have the leverage, you're kind of a victim of the market.
Sure. Okay, Mitchell. I think I'm guessing we don't have time for that, but I am guessing if Mitchell reached out to Paul would be happy to share a few more thoughts on that, because I know Paul had mentioned kind of seeing a little bit of disparity between different regions in the next year. Other than that, I think we have gotten through our questions. And so I want to remind anyone who's listening that all of these gentlemen have a great LinkedIn presence. You can follow them, connect with them there, message them with any additional questions. Again, if you're listening back to this, please leave your questions in the form of a comment on this LinkedIn Live event, and I'm happy to moderate those, jump in, tag some people to get you some answers if you weren't able to make this live show today. But that is all I have. So, gentlemen, thank you so much for being here. Thank you for meeting me for coffee. None of us drank coffee, but that's fine. Oh, fantastic. Chris has his coffee. Thank you, everyone, so much for being here, for listening, and for joining in. And we will talk to you guys soon.
You guys.
Yeah. Thank you very much.